Hello viewers, welcome to my channel. I am Hasham. Presently I am giving the lectures on the subject Managerial Accounting. In this subject the topic is Marginal Costing. So far I have completed 32 problems on Marginal Costing apart from the theory explanation. So hope my regular viewers have already watched the theory video, because without understanding the theory you cannot be able to understand the problems. The problems are based on the theory. So I have explained in detail regarding what is marginal costing, what are the different techniques under marginal costing, like break-even analysis, cost volume profit analysis, margin of safety. All these things I have explained in detail in the first video, theory video. So if you have not watched that video, I suggest you to go to the playlist of my channel. There you can find the subject Managerial Accounting. Select the subject, select the topic Marginal Costing, watch the video, complete theory video, and starting first, second, third video are very important. You will get a good grasp on the subject by watching the initial videos. Then you can watch this video. Now in this video I am starting the problem 33. But before starting the problem, I expect my viewers to have a hard copy printout of the problems, which I have given in the link under my description. So take a printout, keep it ready before watching the problems. Now I am reading out problem number 33. See here. The sales and profits during two periods are as under. Period 1, sales are 20 lakhs, profits are 2 lakhs. Period 2, sales are 30 lakhs, profits are 4 lakhs. So two period data is given. Period 1, period 2. Sales are given, profits are given. Calculate first point, PV ratio. Second, break-even point. Third, sales required to earn a profit of rupees 5 lakh. Fourth, profit is how much when sales are 50 lakh. And fifth, margin of safety at a profit of rupees 2,50,000. So 5 different questions are asked, right? So the solution will be like this. Period 1 to sales are given, profits are given. In the first period the sales are 20 lakh and the profit is 2 lakh. In the second period sales are 30 lakhs and profits are 4 lakh. This is the data given. Now one by one question we will attempt. The first question, it is asking you to calculate PV ratio. Whenever two period data is given, the formula to be applied to calculate PV ratio is change in profit by change in sales into 100. Change in profit divided by change in sales into 100. This formula will be applied whenever two period data is given, right? Change in profit. Profit, how much changed from one period to second period? 2 lakh to 4 lakh. From 2 lakh to 4 lakh, so 2 lakh rupees is the change. Similarly, sales changed from 20 lakhs to 30 lakhs, means 10 lakh rupees. From 20 to 30, so 10 lakh rupees is the change in sales. So 2 lakh divided by 10 lakh into 100, 20% is the PV ratio. First question completed. Second question, BEP, break-even point. The formula for BEP is fixed cost by PV ratio. PV ratio already we have calculated, but fixed cost is not given in the problem. So first we need the fixed cost, then we calculate BEP. How to calculate fixed cost? We use a formula PV ratio. It's a multi-purpose formula. In many cases we apply this formula to find out a number of things. So here we apply PV ratio to calculate fixed cost. The PV ratio formula, C by S. In place of C I can write S minus V, or I can write F plus P. But what I need, I want fixed cost. So to find out fixed cost I will take F plus P. In place of C I will write down F plus P. F plus P by S. So PV ratio already we have calculated 0.2. 20%. If I take 20 here, I should multiply by 100. If I do not multiply by 100, you have to take 0.2. Fraction percentage. If you take percentage, multiply by 100. If you take the fraction, don't multiply by 100, you get the same answer. So why unnecessary to take percentage? It is better to take fraction. We'll get the same answer. So 0.2 I am taking. Now F, fixed cost. We don't have. We have to calculate. Now profit. Now we have the profit. Two profits we have. First period profit, second period profit. Any one of the period profit you take. Whether you take first year profit or second period profit. Any profit. Right? So I am taking arbitrarily first profit. First profit is 2 lakh. So in place of profit 2 lakh. Sales. The same sales we should take for which we have taken the profit. Profit we have taken 2 lakh. So how much are the sales here? 20 lakhs. So denominator 20 lakh. Now I am making cross multiplication. F plus 2 lakh is equal to 0.2 into 20 lakh. So 0.2 into 20 lakh you will get 4 lakh. Now bring this 2 lakh to RHS. So plus 2 lakh will become minus 2 lakh. So F is equal to 4 lakh minus 2 lakh, fixed cost 2 lakh. Now we got the fixed cost, rupees 2 lakh. Now easily we can find out the BEP, break-even point. So BEP is equal to fixed cost by PV ratio. So 2 lakh divided by 0.2, you will get 10 lakh rupees. That's all. 2 points we have completed. We have calculated the PV ratio, we have calculated the BEP. Now third question. Sales required to earn a desired profit of rupees 5 lakh. In the first video I have explained you, I have given the formulas. The formula number 6 I have given. Sales required to earn a desired profit. The formula is fixed cost plus desired profit divided by PV ratio. See here, all the problems are based on the formula. The first step, you must remember the formula. If you are unable to remember the formula, you cannot do any problem on marginal costing. Secondly, it needs some practice. Just watching the video and thinking that I got a good command on the subject, it's not correct, it's not fair. If you want a good grasp, after watching the video, practice the problem yourself independently. Now, sales required to earn a desired profit, formula is fixed cost plus desired profit divided by PV ratio. Fixed cost plus desired profit by PV ratio. Fixed cost just now we got, how much is the fixed cost? 2 lakh. And desired profit, how much we want? 5 lakh. Divided by PV ratio 0.2. So 2 lakh plus 5 lakh, 7 lakh. 7 lakh divided by 0.2, you will get 35 lakhs. These are the sales required. When we make a sales of 35 lakhs, we will get a profit of rupees 5. 3 bits more. Now I am coming to the fourth bit. Profit. Profit is how much? When sales are rupees 50 lakhs. If sales are 50 lakh, how much would be the profit? Again, I'll make use the PV ratio formula. Easily I can find out. PV ratio. The formula is C by S. In place of C, I am writing F plus P because I need P. I need profit. So PV ratio 0.2. Already we have calculated here. And F, fixed cost. Fixed cost already we have calculated 2 lakh. Plus profit. Profit I want to find out. I have to find out the profit. Divided by sales. Sales are 50 lakhs. So in all this equation, the unknown variable is P. Now I am making a cross multiplication. So 2 lakh plus P is equal to 0.2 into 50 lakh. So 0.2 into 50 lakh will get 10 lakh. Now bring this 2 lakh to RHS. So plus 2 lakh will become minus 2 lakh. P is equal to 8 lakhs. Profit is 8 lakh. So when sales are 50 lakhs, profit will be 8 lakhs. That's all. 4 points completed. Now last, fifth point. Margin of safety, MOS at a profit of rupees 2,50,000. I have given two formulas for calculating MOS, margin of safety. One, actual sales minus break-even sales, one formula. Second formula, profit by PV ratio. Any formula we can apply depending on the information given in the problem. In this problem, we are given the profit. So I am applying profit by PV ratio. The formula for MOS, profit by PV ratio. Profit 2,50,000 given here. PV ratio already we have calculated 0.2. So 2,50,000 by 0.2, 12,50,000 is the MOS, margin of safety. That's all. So this is the problem number 33. Now 34th problem. The following figures related to a company manufacturing a varied range of products. Year ended 31st December 1980 and 31st December 1981. So 2 period data is given. exactly similar to the previous problem. What is the new point? Total sales are given and total cost is given. We are not given the profit. Previous problem sales and profit were given, but in this problem sales and cost is given. So remember one equation: profit is equal to total sales minus total cost. Total sales minus total cost, you will get the profit. The profit is not given in the problem. We can calculate. We know it how to find out the profit. Sales minus cost is equal to profit. So here we are given 1980. Total sales are 2,22,300 and total cost is 1,98,360. तो माइनस कर देंगे 2,22,300 minus 1,98,360. You will get the profit of first year. Second year 1981. Total sales are 2,45,100 and total cost is 2,14,320. Minus कर देंगे sales minus total cost, will get the profit. Exactly similar. Now assuming stability in price with variable cost carefully controlled to reflect the predetermined relationship and an unvarying figure of fixed cost, calculate. All these are the assumptions to be applied for calculating various marginal costing items. First one, the profit volume ratio. First question it is asking you to calculate PV ratio. Exactly similar to the previous problem. PV ratio is equal to change in profit divided by change in sales into 100. Then it is asking you B point, fixed cost. C point, fixed cost percentage to sales. D point, break-even point. E point, margin of safety for the year 1980 and for the year 1981. That's all. So it's very easy problem. Slight difference is there. Year 1980, 1981. Total sales are given in the problem. Total cost is given. I have opened one more column for profit. It is not given. Profit is not given in the problem. We will calculate. So total sales minus total cost. 2,22,300 minus 1,98,360. You will get the profit 23,940. So first year. 1980 is the first year. Profit is 23,940. Second year 1981. 2,45,100 minus 2,14,320. 30,780. We got the profit of the first year, profit of the second year. Now we can attempt one by one question. The first question is PV ratio. PV ratio is equal to change in profit by change in sales into 100. Change in profit. The 30,780 minus 23,940. 30,780 minus 23,940, 6,840 is the change in profit. Divided by change in sales. तो सेल्स का डिफरेंस मालूम करेंगे 2,45,100 minus 222,300. You will get the change 22,800. Now divide कर दो change in profit by change in sales into 100, 30%. One question completed. PV ratio is 30% or 0.3. We can call it as 30% or we can call it as 0.3. Percentage में चाहे तो 30% आएगा, fraction में बोलेंगे तो 0.3. Right? Now fixed cost. Just like the previous problem, we can find out the fixed cost by using the help of PV ratio. PV ratio formula C by S. In place of C, I am taking F plus P because I want fixed cost. मेरे को fixed cost चाहिए, इसीलिए I am taking F plus P. PV ratio. Already we have calculated 0.3. I am not taking 30. 30 लिए तो फिर यहाँ पर multiply by 100 करना. अगर multiply by 100 नहीं करेंगे तो यहाँ 0.3 लो. You'll get the same answer. Then F fixed cost we don't have, but profit. Now take the profit of any one of the year. First year का profit लो या second year, कोई भी एक साल का profit. जो साल का profit लेंगे वही साल का sales. The same year we have to take the sales. If we have taken the profit of first year 23,940, तो profit की जगह पर 23,940 divide by sales. What is the sales of the first year? 2,22,300. 2,22,300. Now I am making a cross multiplication. F plus 23,940 is equal to 0.3 into 222,300. So F plus 23,940 is equal to 66,690. Now take this 23,940 to on RHS minus. So fixed cost 42,750. Two questions completed. Now third question. Fixed cost percentage to sales. fixed cost percentage to sales. The formula will be fixed cost divided by sales into 100. What is the percentage of fixed cost on sales? The formula fixed cost divided by sales into 100. For both the years we have to calculate. First year 1980. Percentage of fixed cost to sales is equal to fixed cost by sales into 100. How much is the fixed cost? Just now we have calculated 42,750. The numerator 42,750 divided by sales. How much is the sales for the first year? 2,22,300. Here I am taking 2,22,300 into 100. 19.23 is the percentage of fixed cost on sales for the first year. Second year, same way, 1981. Percentage of fixed cost on sales. Fixed cost 42,750. Fixed cost will remain same first year as well as second year. Sales will change. Second year sales are 245,100. So denominator 245,100 into 100, 17.44. Then break even point. 3 points, 3 questions over. Fourth question, break even point. We know the formula. Every problem we are applying the formula for BEP. The break even point is equal to fixed cost divided by PV ratio. Fixed cost already calculated 42,750. PV ratio already calculated 0.3. So 42,750 divided by 0.3. 1,42,500 is the break even point. That's 4 points complete. Last and final point, MOS. MOS for both the years. It is asking you to calculate the margin of safety for both the years, first year and second year. We know the formula. The formula, 2 formulas are there for MOS. Actual sales minus BEP sales. Actual sales are here and break-even sales are here. So actual sales minus BEP sales. This is the first method. Second method, profit by PV ratio. We have the profit and divide by PV ratio. We'll get the same answer. You apply any formula. I am applying the second formula, profit by PV ratio. MOS is equal to profit by PV ratio. The first year profit 23,940 divided by 0.3, 79,800 MOS of first year. Second year, what is the profit? 30,780. 30,780 divided by 0.3, 1,02,600. This is the MOS of second year. This is the end of problem number 34. Totally 34 problems we have completed on marginal costing. Now see the next problem, 35th problem. RAM agencies sold during 1990, 91 and 91, 92. So 2 years data is given. The first year is 1990, 91. Second year is 91, 92. So how many units are sold? 7,000 units are sold. We can call it as first year and second year. The first year is 1990, 91 and the second year is 1991, 92. The first year 7,000 units are sold and second year 9,000 units are sold at rupees 100 each. The selling price per unit 100. So how many units are sold in the first year? 7,000. Each unit 100 rupees. So 7,000 into 100, 7 lakh. So 7 lakh rupees are the sales of the first year. Second year 9,000 units are sold. So 9,000 into 100, 9 lakhs. So first year sales 7 lakh, second year sales 9 lakh. In 1990-91, they incurred a loss of 10,000. Whereas in 1991-92, they earned a profit of 10,000. First year, they incurred a loss of 10,000. And second year, they earned a profit of 10,000. Calculate PV ratio, first point. Second point, fixed expenses. Third point, number of units to be sold where there is neither profit nor loss. The term is called break-even point. It is not specifically asking you to calculate break-even point. What it is asking you is calculate the number of units to be sold where there is neither profit nor loss. It means we have to calculate BEP in units. And lastly, number of units to be sold to earn a profit of 40,000. Means number of units required to be sold to earn a desired profit of rupees 40,000. Seventh formula, last formula we will apply. So this is the problem. Now see carefully. It's exactly similar to the previous problem because two period data is given. Year 1990-91, first year. Second year 91-92. Number of units are 7,000, 9,000 units. And every unit the selling price is 100 rupees. So 7,000 into 100, 7 lakh are the sales. 9,000 into 100, 9 lakh are the sales. Now profit or loss. In the first year, the company incurred a loss of 10,000. So minus 10,000. Second year, the company has earned a profit of 10,000. So plus 10,000. Minus means loss. Loss of 10,000, profit of 10,000. This is the data given. Now we have to attempt one by one each question. The first question is PV ratio. The PV ratio formula, change in profit by change in sales into 100. Now carefully you see, change in profit. Don't think that minus 10,000 plus 10,000 will get cancelled, remaining 0. Normally students will think like this. It's wrong. It is asking you how much profit has changed from first year to second year. So it is minus 10,000. तो माइनस 10,000, माइनस 9,000, माइनस 8,000 ये कंटिन्यू होते होते 0 आएगा, फिर प्लस 1,000, प्लस 2,000, प्लस 3,000, प्लस 4,000 लाइक दैट अप टू प्लस 10,000. तो टोटल चेंज इन प्रॉफिट इज 20,000. तो माइनस 10,000 टू 0, 0 टू प्लस 10,000. तो टोटल चेंज इन प्रॉफिट विल बी 20,000. राइट? तो चेंज इन प्रॉफिट 20,000. Divide by change in sales. Sales changed by 2 lakh, 7 lakh to 9 lakh. So 2 lakh rupees. So PV ratio is 10%. So be careful regarding change in profit. Don't think 0. It is 20,000. From 10,000, from minus 10,000 to plus 10,000. The change is 20,000. So 10% is the PV ratio. Now fixed expense. For calculating fixed expense, we use PV ratio formula. PV ratio is equal to C by S, F plus P by S. We will write down F plus P by S. PV ratio 0.1. 10% can be written as 0.10 is equal to F, fixed cost. We don't have, we have to find out. Now profit. Take any one of the profit. Either you take negative profit or you take positive profit, you will get the same answer. If you take negative profit, तो minus 10,000 और sales की जगह पर 7,000. If you take minus 10,000. If you take plus 10,000, then sales will be 9 lakh. So I am taking this plus 10,000. I am taking plus 10,000. So F plus 10,000 divided by 9 lakh. Right? Now cross multiply. F plus 10,000 is equal to 0.1 into 9 lakh, 90,000. 0.1 into 9 lakh, 90,000. Bring this 10,000 to RHS. Minus 10,000. 90 minus 10, 80,000. Fixed expenses, we got 80,000. Second question completed. Now third question. Number of units required to be sold where there is neither profit nor loss. That means we have to calculate BEP in units. The formula for BEP in units, fixed cost divided by SP per unit minus VC per unit. Selling price per unit minus variable cost per unit. But here in the problem, selling price per unit is given, but variable cost per unit is not given. By using PV ratio, we calculate variable cost per unit. By using PV ratio, we calculate variable cost per unit. So PV ratio is equal to C by S. In place of C, I am writing S minus V. Why I am taking S minus V? Because I want variable cost. I want variable cost. Selling price given in the problem, 100 rupees is the selling price. So PV ratio 0.1. Selling price is 100 rupees given in the problem. Minus variable cost, we don't have, we have to find out. Divide by selling price is 100. So now cross multiply. 0.1 into 100. So 0.1 into 100 you will get 10. 100 minus V. Bring V to LHS. ये minus V इधर ला लिया तो plus V हो जाएगा और ये 10 right hand side minus 10. तो V is equal to 90. That means variable cost per unit is equal to 90 rupees. Now easily we can find out BEP in units. BEP in units is equal to fixed cost divided by SP per unit minus VC per unit. Fixed cost already we have calculated 80,000. Selling price given in the problem 100 and variable cost per unit just now we have calculated 90. So 80,000 divided by 10, 8,000 units. The break-even point is 8,000 units. Number of units required to be sold where there is neither profit nor loss is 8,000. 8,000 unit बनाएंगे तो no profit no loss. If we sell more than 8,000, we'll get the profit. If we sell less than 8,000, we incur loss. That is the meaning. Now, number of units required to be sold to earn a profit of 40,000. In the first video, in theory introduction, I have given 7 formulas. The 7th formula was number of units required to be sold to earn a desired profit. Formula will be fixed cost plus desired profit divided by SP per unit minus VC per unit. Selling price per unit minus variable cost per unit. So here fixed cost 80,000, desired profit 40,000. Selling price per unit 100 rupees given in the problem, variable cost per unit 90 rupees. So 80 plus 40, 1,20,000 divided by 10, 12,000 units. By selling 12,000 units, we can get a profit of rupees 40,000. That's it. This is the end of problem number 35. Now, 36th problem. I'm reading out the 36th problem. Hyderabad Industries Limited sales amounted to 45,000 and total cost 40,000 during the half year ended 30th September 1991. So here 1 year is divided into 2 parts. First 6 months, second 6 months. First half year, second half year. The first half year is ending on 30th September 1991. First half year. Right? During this first half year, the sales are 45,000 and total cost is 40,000. Up second half year, during the half year ended 31st March 1992. तो पहले 6 months complete हो रहे हैं 30th September 1991. The second half year ends on 31st March 1992. So during the second half year, the sales were 50,000 and the total cost was 43,000. When sales and total cost is given, we can easily find out the profit. Profit is equal to sales minus total cost. Sales minus total cost. Now calculate for the year ended 31st March. We have to calculate for 1 year. The data is given for first 6 months, second 6 months. But we have to calculate for the full year. PV ratio. Then break-even sales in value, fixed expenses, margin of safety. The 4 questions are asked. One by one we can attempt. See here, half year ended. Half year ended 30th September 1991, first half year. Second half year ended 31st March 1992. During the first half year, the sales are 45,000, total cost is 40,000. So sales 45, total cost 40. So sales minus total cost will get the profit. Profit is 5,000, 35 minus 40. Second half year, the sales are 50,000, total cost is 43,000. So 50 minus 43, 7,000 rupees is the profit for the second half year. Now calculate for the year ended 31st March 1992. Year ended. यानी 1 साल के लिए जिसमें first 6 months and second 6 months. For 1 year, we have to make the calculation. Now PV ratio. Change in profit by change in sales. How much profit changed? From first period to second period, 5,000 to 7,000. How much changed? 2,000. So change in profit is 2,000. Divided by change in sales. How much sales changed? 45 to 50. So 5,000 rupees sales changed. So divide by 5,000. So 2,000 by 5,000 into 100, 40% or 0.4. This is the PV ratio. First question completed. Now second question, break-even point, BEP. To calculate BEP, we require fixed cost. Without fixed cost, we cannot calculate break-even point. So first we calculate fixed cost by using PV ratio. So PV ratio is equal to C by S. In place of C, I am writing F plus P because I want F, fixed cost. Now PV ratio 0.4. Now fixed cost we have to calculate. Now profit. Now I need the fixed cost for 1 year. I don't require for 6 months. So I require the fixed cost for 1 year. So I should take the profit for 1 year and sales for 1 year. First half year, how much is the profit? 5,000. Second half year profit, 7,000. What is the total profit for 1 year? 12,000. 12,000 is the profit for 1 year. Similarly, sales I require for 1 year. First half year sales 45,000. Second half year sale 50,000. Total sales 95,000 for 1 year. Previous problem we have not done like this. The previous problem, one period was 1 year. Here one period is half year. One period is half year. So I am taking for 1 year complete sales 95,000. So cross multiply F plus 12,000 is equal to 0.4 into 95,000. So 0.4 into 95,000, 38,000. Now take this 12,000 to RHS. 38 minus 12, 26,000. So fixed cost for the year, complete year, 26,000. Now BEP. Easily we can find out BEP. Fixed cost by PV ratio. The fixed cost is 26,000 for 1 year and PV ratio is 0.4. So 26,000 by 0.4, 65,000. That's 65,000 is the break-even point. Third question C is fixed expenses for the year. Already we have calculated. For calculating BEP, we have calculated fixed expense. How much fixed expense? 65,000. The fixed expense for the year is 26,000. 26,000 is the fixed expense. 65,000 is the BEP. Then MOS. Last and final question it is asking you MOS, margin of safety. So two formulas are there. The first formula, actual sales minus BEP sales. How much is the actual sales? 95,000. Actual sales 95,000. What is the break-even sales? 65,000. So 95,000 minus 65,000, 30,000. Or profit by PV ratio. How much is the profit? 12,000. 12,000 divided by 0.4. So 12,000 divided by 0.4, 30,000. Any formula you apply. Actual sales minus BEP sales you apply or profit by PV ratio you apply, you will get the same answer for margin of safety. That's it. So this is the end of problem number 36. Now see the 37th problem. A company making and selling a product has made the following estimates. Selling price per unit 20 rupees, fixed cost rupees 15 lakh a year, variable cost 16 rupees. The selling price per unit 20 rupees, variable cost per unit 16 rupees and the total fixed cost 15 lakh. Sales volume 5 lakh units. So the company has sold 5 lakh units. And suppose a selling price decrease by 10%, result in 15% increase in volume. Now normally what will happen when selling price decreases, the demand increases, the sales will increase. Here company thinks that if we decrease the selling price by 10%, then volume will increase by 15%. What will be its profit? Agar aisa hua, if we decrease the selling price by 10%, our volume will increase by 15%, then what will be the profit? That is the question. It's very easy. See, selling price per unit is 20 rupees given in the problem. Variable cost per unit 16 rupees given in the problem. The total fixed cost is 15 lakh rupees and the current volume of production, how many units, are 5 lakh units. This is the current information. Now the company wants to decrease the selling price by 10%. Selling price decrease by 10% leads to 15% increase in volume. Volume 15% बढ़ जाएगा. So new selling price. What is the present selling price? 20 rupees. Now 20 rupees में से 10% minus करो. So 20 rupees 10% is 2 rupees. So deduct 2 rupees. 20 minus 2, 18 rupees. The new selling price will be 18 rupees after deducting 10%. Now volume. The volume will increase by 15%. What is the present volume? 5 lakh. Present volume is 5 lakh. To 5 lakh add up 15%. So 15% of 5 lakh is 75,000. 15% of 5 lakh is 75,000. So add up 5 lakh plus 75,000. 5 lakh 75,000 units is the new volume. Now ultimately we have to find out the profit. Profit we have to find out. Now sales, calculation of profit. Sales. How many units we are selling? 5,75,000 units we are selling. What is the selling price per unit? 18 rupees. Selling price per unit 18 rupees. So 5,75,000 into 18. 1 crore 3,50,000. 1 crore 3,50,000. That is the sales. From sales we deduct the variable cost. The variable cost are 5,75,000 into 16. Per unit variable cost remains same. There is no change in variable cost and fixed cost. The only change in selling price and volume. So 5,75,000 into 16, 92 lakh rupees is the variable cost. Subtract sales minus variable cost, will get the contribution. The contribution we got 11,50,000. 11,50,000 is the contribution. From contribution deduct the fixed cost. The fixed cost will remain constant, whatever be the level of activity. The fixed cost is 15 lakh. 15 lakh rupees fixed cost. Subtract 11,50,000 minus 15 lakh. You are getting minus 3,50,000. 11,50,000 minus 15 lakh. You are getting minus 3,50,000. So minus denotes loss. That means the company will incur a loss of 3,50,000 if it decreases the selling price by 10%, leading to increase in volume by 15%. तो कंपनी अगर सेलिंग प्राइस 10% कम कर दिया, वॉल्यूम 15% बढ़ गया, तो it will incur a loss of rupees 3,50,000. That's all. This is the end of problem number 37. So totally 37 problems have completed in explaining the marginal costing technique problems. If you are regularly watching, hope you understood the topic of marginal costing technique. Each and every problem will be a different problem, peculiar problem. With full concentration, watch the video, then practice yourself. Then only you can be able to get the command on this subject. It's very interesting subject. This managerial accounting is very interesting subject, and in that also marginal costing is very, very important. So hope if you are satisfied with my lecture, give a like to the video. Share this channel in your group, in your friends, so that more students can watch the video, can increase their knowledge. Give your comments, and lastly, don't forget to subscribe if you have not yet subscribed my channel. We'll continue the next problem in the next video.